Trade Finance in Africa, brought to you by Africa Export-Import Bank.
Welcome back to Open Exchange. We're going to talk trade finance now. In the Johannesburg Open Exchange studio is Yusuf Ali Khan, Head of Trade for Africa at Citi, and also Dave Butler, MD of Control Risks. And in the Cape Town studio, Nick Boraine from KD's BNP Paribas. Can I start with you, Yusuf, if possible? I noticed that trade's always in focus, but there's something going on between South Africa and the European Union at the moment. It says here, despite some muddy patches along the road, relations between SA and the European Union have developed into a foreign policy success story. A few worries, though, about the trade relationship between the two. Generally speaking, obviously incredibly important, the EU relationship. Is trade booming?
Thank you very much. Trade, EU has been, historically, the largest trading partner for Africa. And, in this regard, we've had capital goods flows coming in from the major European exporting countries such as Germany, Italy, and the other sort of EU states, the Nordics, for example. And the outflows from Africa have been on the commodity side predominantly. However, what has happened is that in the last 2 years, there has been a shift where China and Asia have actually overtaken the EU in terms of the inflows and outflows from Africa into that part of the world.
Dave, from your point of view, given what Yusuf has just said, what sort of implications have there been because of these changes in the trading environment? What has been the impact on trade finance? Do we have to become more creative? Are we still in the traditional way of financing deals?
I think we need to be a little bit more creative. I think that, as Yusuf pointed out, there's a sea change in flows of investment funds into Africa, and a lot of it's driven through the BRICS partners, bilateral trade agreements. It's not just China and Asia, but we're seeing a lot of interest from Russia, and the implications of that are that there is significantly more cheap money for companies coming from those regions as part of the investment package. So it requires being a lot more creative. That said, it's the environment has changed. So it's a lot of investors and companies looking into Africa and South Africa as well are a lot more sophisticated in how they perceive some of the risks and structure their financing deals.
Let's go to Nick now. You've been talking about foreign direct investment to me before we came on air. Of course, FDI inextricably linked to trade in Africa. And FDI from a South African point of view, not particularly good, but from an African point of view, has actually been buoyant for a few years. Do you see that continuing and impacting trade?
Yeah, it certainly does. There's an institute called the Multilateral Investment Guarantee Agency, which is a part of the World Bank that does a huge assessment of what FDI, people who potentially are going to invest, what they think and what are their main barriers that they feel to investment. There's political risk is way at the top of that. This agency breaks down political risk into adverse regulatory changes, breach of contract, transfer and convertibility restrictions, civil disturbance, non-honouring of government guarantees, expropriation and nationalisation, terrorism and war.
It's quite a list.
It's quite a list, and it goes up, the order changes. So last year everything was about MENA, it's still about MENA. So war and terrorism were much higher. But it's quite interesting to map those against the kinds of risks that FDI or foreign investors have about South Africa. And clearly, if you look, for example, at the mining sector, uncertainty about regulatory changes, the state involvement in the mining sector document, the changes in taxation, the stability of licenses. This is always about, for the investor, the safety of the asset, the predictability of returns. And I think the guys who provide insurance against those risks map it really carefully, and politics is still way up there.
Yeah, Yusuf, do you find that? I mean, obviously, your position is head of trade for Africa at Citi. How important a part in structuring a trade finance deal is the political risk, and what sort of a premium would be attached to a country that is perceived to be politically risky?
Yes, I mean, I think what the previous gentleman mentioned with MIGA, certainly, risk mitigation is the name of the game. When you look at the 53 plus geographies in Africa, each one is unique. Each one has its own set of economic and political ramifications. But I would add, export credit agencies have been involved in financing flows into Africa for several decades now. The likes of US Exim Bank, Overseas Private Investment Corporation, OPIC of the US, the major EU export credit agencies such as COFA, SACE, ECGD have all been very, very active in financing capex, capital goods flows into Africa. And what export credit agency guarantees do is that they provide lenders under those guarantees the ability to extend tenors and to actually provide competitive pricing than would normally be available in let's say the bank market. In some of the countries of Africa, the bank market is not deep enough and extends maybe to 2, 3, maybe 4-year tenors, whereas with an export credit agency guarantee, you can look at extending those tenors to around 10 years, and in some cases even 15 years. We recently did 2 deals in Ghana, where the tenors were 15 years and 13 years respectively, backed by ECIC, the South African Export Credit Agency, and ECGD, the UK agencies, and both of those were in the infrastructure space.
Very good. Is that unusual, those terms that you just spoke about, 13 and 15 years?
For Ghana, yes, those, the bank market, would probably be 3-4 years in Ghana. In addition to that, the pricing that we offer, given that we are looking ultimately at a guarantee or cover that it would be, in this case, South African sovereign risk with ECIC and UK government risk, that pricing tends to come down significantly, because you're not then looking at Ghana risk primarily. You are looking then at South African or UK risk, which has a tremendous benefit for the borrower, because ultimately those cost savings can run into the millions of dollars.
Dave, over to you now. You mentioned cheap money in the last chat we had. How much of the cheap money filters down to a trade deal? It's all very well having zero interest rates in certain very important geographies like the United States and Japan, etc. But does that translate to cheaper trade finance at the same time?
I think that I think that it's difficult to assess, and I'm not an expert in the area of trade finance. But just to take a look at, if you look at the cost of financing deals on the continent, and you look at sort of how it's changed over the years, it's very interesting to look at the political risk implications, because that's the key driver in the cost of finance. And I think in the past, people would look at Africa as one entire market, and at the top of the political risk indicators would be civil war and sort of the more sort of hard end of it. But now when you look, it's the markets, the investors are very sophisticated, the markets are very different, and the risk factors change dramatically. Our commentator in Cape Town mentioned all of the various elements of that, and I think what we're seeing is that the influx of finance means that the deals are there, the financing's there. It's cheaper than it has been in the past, but it's, there is significant risk. The rewards are there, but there are significant risks, and it's all driven by the commodities market to a large extent.
What about logistics? Because that's something that you do know more about than you do trade finance by your own admittal. Logistics, obviously a risk as well. Absolutely. When a company's looking to invest, you're looking at a range of operating risks, and the World Bank itself has mentioned figures around sort of
close to $100 billion of investment yearly on infrastructure across the continent. And that is a significant risk. I mean, we need to be clear that a lot of inbound FDI onto the continent of Africa is still driven by natural resources and commodities. And they're significant investments. And we need, the investors need to be able to get the product out to the markets that they're sold in. And that's where the real challenge is. And a lot of this international FDI that's coming into the continent from the BRICS partners and others bilaterally are geared towards infrastructure investment. I mean, we've seen with Obama's recent visit onto the continent a real move from the US government to invest in energy. Energy infrastructure across the continent, and that's been reflected in a lot of the investment flows and financing that we see.
Nick, we were talking earlier on in the market segment about the United States of America and companies that are reporting results at the moment. The ones that are domestically focused in the United States are doing extremely well. Do you think there'll be a time in the future where the majority of trade will not be between Africa and China and Africa and Europe, but within Africa itself? Not self-sufficient, obviously, because no man is an island, but on the other hand, that is going to grow should Africa fulfill its potential. So internal African trade, exciting for the future.
Huge. I think if you look at track it, South-South FDI and other flows are becoming as important in the long run as developed countries into developing countries. So yeah, it's extremely important.
And will be growing in the future.
Well, maybe to say even more. That will be growing in the future, and we're seeing it now, Nigerian investments into South Africa, the Dangote, other things like that. But this whole idea of South Africa, the last great frontier, Africa is demographically, it indicates future growth, retail, banking, those sorts of things, not just resources, and that's going to be more and more important driver of these kinds of investments in the next 20 years.
And of course that will have implications on trade finance issues in the future as well. Nick, thank you very much for your time this morning. That's Nick Boraine from BNP Paribas Cadiz, based in Cape Town, and in Joburg was Yusuf Ali Khan, the Head of Trade for Africa at Citi, and also Dave Butler, MD of Control Risk. Gentlemen, thank you very much for your time. We're going to take a break now, and that's it for me on Open Exchange, but the show will continue with Wole in Nigeria. I'll see you at lunchtime on Power Lunch.
Trade Finance in Africa, brought to you by Africa Export Import Bank.